You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we're going to respond to 2 listener questions. We've been getting more and more of these, so we'll do our best to respond to as many as possible in upcoming shows. Our first question comes from T-Man. He asks, can you recommend an options book for a novice trader? Well, first, thanks for the question, T-Man. The book I would offer is Brian Overby's Options Playbook. What I like so much about Brian's book is the clear, straightforward approach he takes in explaining options, option strategies, and especially risk. The illustrations in his book help readers, especially investors new to options, get a clear understanding of what risks exist with different option strategies. And our next question comes from Doc. He asks, any thoughts on mini options on a shoestring budget? Well, Doc, the concept behind mini options was to give investors an opportunity to trade options on high-priced stock and indexes. Rather than each option corresponding to 100 shares, mini options represent 10 shares of the underlying. The program started back in March of 2013 with minis listed on Amazon, Apple, Google, GLD, which is the gold index, and SPY, the S&P 500 index. Now, the minis had some interest early on, but for a number of reasons, interest waned over the next year or so. No new mini option series are being listed on the original 5 underlyings. Now, remember, options do offer investors an opportunity for leverage, given the 100 shares of the underlying each contract represents. So whether you're on a shoestring budget or a more sizable one, the key is to do your homework before making any investment decisions. Please remember, Doc, to you and all our listeners, you can build a great foundation of options knowledge at optionseducation.org. And remember to sign up for the My Path tutorial program on our website. Again, that's at optionseducation.org. Thanks to T-Man and Doc for today's questions. That's today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today for Strategy Spotlight is Kevin Davitt, instructor at the Chicago Board Options Exchange, or CBOEs Options Institute. Welcome, Kevin.
Thanks, Joe. How are you?
Doing great. How about yourself?
I cannot complain at all.
Oh, that's good. How about if we start by first introducing you to our listeners, and then we'll get into today's topic of rolling. So tell us about yourself.
All right. Well, I appreciate that opportunity. Thank you for having me on. I am, as you mentioned, an instructor here with the Options Institute, the education arm of the CBOE. I ended up in this role, like some of my colleagues that you've had on previously, because I have considerable floor-based experience as far as options are concerned. So I started in this business in the late 90s. I was a clerk for what at the time was one of the biggest market-making groups in the business. We had people on each of what at that point in time were only 4 options exchanges. I traded on the floor, so from the late 90s to 2007. I have seen that business transform fairly markedly. Since that time, I have traded commodity options as well. I have done some work in a brokerage capacity, and for the past year, I have been back at home, if you will, with the CBOE in an education role. Well,
the gang, the team over there at Options Institute, you and the rest of the team just do a phenomenal job. So it's really great to have you on to offer, some of your insights and wisdom about the topic of rolling option positions. I know you and I could probably talk about this for certainly hours, if not days. Where would you like to start our discussion of why investors roll option positions?
I could indeed talk about a topic like that for quite some time. I think typically the best place to kind of jump from as far as any options topic is, do you understand what, in this case, rolling means, and why might an option trader want to, need to? So does that sort of framework work for you? Does that make sense?
That's beautiful. Now, are you interviewing me, or should I interview? No, that was perfect. Absolutely perfect. Yeah. No, it's outstanding. How about if we start right there? What do we mean by rolling an option position?
All right. So at least from my perspective, rolling means moving whatever option position you have on either into different strikes and oftentimes into different months. It could be just one or the other. It could be a combination of both of them. In any case, I think when you're talking about something like this, the best way to go about it, or hopefully understand it, is to run through an example. And so in our education role, we talk a lot about this hypothetical underlying X, Y, Z. So I'll just talk about that and imagine it's a $50 stock or ETF or whatever your audience might be trading. And let's just say, for example's sake, that I have been short the 47.5 40 put spread, and I sold that thing 2 months ago, and I collected $2, and now we are moving into expiration. Say it was a September option, so we're going into expiration last week, and I have realized the vast majority of my premium. So I sold it for $2. What's that?
Can I just clarify one thing? So you're short the 47 put, long the 40 put for $2, yes?
Yes, absolutely. I'm sorry, and thank you for making that clear. So I am
Okay.
short the slightly out of the money put, and I own a further out of the money put. Let's assume I sold that for $2, and then let's say last week at some point I could buy that spread back, which is moving into expiration, pay a quarter, and then consider rolling. So this is many option strategies are something that can be repeated on a monthly, on now, a weekly basis, depending on what underlyings you're looking at. But I'm looking to stick with this strategy. I like the defined risk, and if I ended up long this XYZ underlying at some point, I'd be comfortable with that. But I want to move that out into December options, okay? So assuming I'm fine with those same strikes, one roll would be I need to buy back the September 47.5, what did I say, 40 put spread?
Exactly.
And I'm going to pay, let's imagine, a quarter on that thing. But at the same time, I'm going to turn around and sell a December 47.5 put, and I'm going to buy a December 40 put to kind of define my risk out a couple months in time. So a roll like that where you're covering one spread and moving into a new spread would have 4 legs. So that's a relatively complex example, but if something like that makes sense, and in terms of debit and credit, in that scenario, you're buying back a short spread for a quarter and you're moving out a couple months in time and selling the same strikes and buying the same strikes, you would be taking in a credit in that scenario, okay?
That's crystal clear.
Okay.
So, as you're rolling that with the 47.40 put spread trading for a quarter, as you said, the 47 put is still a little bit out of the money. So that spread is clearly working for you. Let's go to maybe example B, where we still have on we're short the 47.40 put spread, but the stock is trading at 46, let's say.
Okay.
What are your choices there?
All right. That's a great scenario to run through, because if you're new to options, at some point this is going to happen. Like whatever the saying is, the best laid plans of mice and men. When we put on an option trade, ideally we have good reason for that, and we think that we're in a statistically strong position to make money on this thing. But the market, we could run through countless examples where we've been humbled. And so assuming we sold this 47.5 put and we bought the 40 put before, and now all of a sudden the market's at 46. So in this scenario, and we're assuming again we're moving into expiration, is that correct?
Yes.
All right. So in this scenario, that 47.5 put is going to be trading right around parity, probably a little bit before, because we have a day or a couple of days until expiration. What I mean by parity is if we have an underlying at $46 and a short 47.5 put, parity on the 47.5 put with the underlying at 46 is $1.50. Does that make sense? Is that clear?
And did you say the strike is the 47.5?
Yeah, and our underlying's at $46.
Bingo. Okay. Yep.
All right. So that put, and certainly that put spread, is going to be trading for a bit more than $1.50. That we are looking to avoid assignment likely in this scenario. So a point on that. In many cases, people employ option strategies because it allows them to be kind of capital efficient. They can use the leverage that options afford, and in many situations, they don't necessarily want to assume a long or short stock position. So in this scenario, I don't want to buy XYZ at 47.5. I don't want to get assigned on this. So I want to take that risk off and move out and potentially further away from the money. Okay. So here I'm buying that same put spread back. but I'm going to be paying significantly more because the stock moved in to a degree that's detrimental to my spread. Okay. And I now have, or at least in my experience, there's a couple alternatives. If I moved into that same spread in December, I'm likely to take in a credit again for moving out a couple of months, but it will likely be less than the scenario I outlined before where I'm covering an out-of-the-money put spread that's very short-dated and moving 3 months out. In this scenario, because it's in the money, many people choose to then move further away. So I'm short a 47.5 put. Maybe in this scenario, and the underlying is 46, maybe I move out to December, and now I sell a 45 put, okay? So I'm selling an out-of-the-money put, and I'm moving out a couple of months, and let's say I buy the 40 put again, so now I only have a $5 wide put spread that I'm short. In this scenario, I'm going to be likely doing that for a debit, meaning I'm paying out more than I'm taking in to move down and out, to move down strikes further away from the money and out in time. Did that make sense?
Well, it does to me. You've got that 47.5 put that you're short. It's $1.50 in the money. And as you say, it's going to trade maybe a little bit more than that. So you're probably paying, say, 1 3/4 for the closing side in September. And then I guess, depending on where vols are, you may not get quite that 1 3/4 for the 45-40 put spread like you suggested.
Yep.
So what, from a position management standpoint, how do investors know, or, how do they create pivot points where, they close something that's going against them and roll? Are there any recipes for that?
This is maybe a little bit cliche, but it's something I genuinely believe, and I say it often because I have conviction. I think option trading is part art and part science. The science part you must have, the foundational understanding of how options work, why they work that way. You must have that before you proceed. What we're arguably talking about here is that art portion, and I think that comes in time. But to take that maybe one step further, and again, in my experience, having a plan before you put a position on for the scenario where the market doesn't do what you're hoping it does do is a very good idea and a way to kind of direct that scenario. So to avoid the I'm not sure what to do, to kind of write down, here, I have this underlying at $50. I'm selling a 47.5 40 put spread. And if that spread moves from $2 to $3.50, I'm covering it. That's one example, okay? Or I'm rolling it. So it's forced accountability. I don't believe that hard and fast rules are always necessary, but that kind of discipline is something that I've seen in consistently more successful options traders. And so some people will look at if the delta of an option that I'm long or short goes from one to another number, perhaps I roll in that scenario. Maybe the rule is I'm selling 3-month options, and when we get to 2 weeks to expiration, I cover them. Again, there are countless ways for you to craft your art, but in my experience and from my perspective, having a plan for the scenario where the market does not do what you want tends to benefit those disciplined types that go about it that way.
That's just awesome, Kevin. And listeners, Kevin said it a few times, but having a plan before basically an exit strategy before you initiate the position. It kind of puts you in a position for forced accountability and just really kind of forces a discipline on you. So, Kevin, that's just fabulous stuff. You talked about art and science, and that art is pretty straightforward, but the science takes a little bit longer to kind of turn into art, if you will. Big picture in terms of rolling, doing rolls for debits or credits. Does it matter? And what's the motivation possibly for both?
Well, it definitely matters because, you and I trade in our account now. We have to know whether I'm taking money in, whether I'm paying money out on any given transaction, just for straight up accounting purposes. And beyond that, what does it mean? Really understanding the risk that you're assuming, and I think this does sort of still go hand in hand with the having a plan. So I'm gonna just quickly walk you through a scenario that I think would be that is fairly commonplace and not one that I would advocate for. I think many people get introduced to options trading, and eventually they believe that they're better off being agnostic from a directional standpoint. So they move toward iron condor trading, and often they do it on indexes. Okay? I have seen this happen. And they start trading iron condors, and they have success, but they don't really understand the risk that they're assuming. And I'm assuming in this scenario that they're selling credit spreads both above and below the market. And you look at an example of like the past 2 months, where until a week and a half ago, we had very, very little market volatility. And then all of a sudden, you get a couple of days where the market moves lower, and potentially one of your short strikes is threatened, and you make the decision to, rather than potentially roll your position out of risk and do so at a debit, to add to a position and move out just so you take in a credit. Does this make a little bit of sense?
It does to me. I hope our listeners are with you. I think they are.
So, in my opinion, doubling down just to get a credit or only looking to do rolls that get you a credit is a potential recipe for disaster, and I've seen that happen.
Okay. That's good advice. Do you think, you initiate a position and, do you find, many people roll or shrink their position to take, let's say they did something for a debit, and do they roll to just, and let's say things are going their way, to just take some of the money off the table? Or do you find most investors, are in with their full allotment and then get out with their full trade as well?
Man, that's a good question. I think in scenarios where things are working well, we tend to be creatures of habit and stick with whatever number of spreads or what have you we have been trading. And it's only when our proverbial feet are put to the fire that we have these decisions to make. And I'm not saying I'm right or wrong in this scenario, but I think that's fairly typical human behavior. There is a psychological element that is in play, and I have behaved that way. Perhaps you have as well.
Indeed.
And so I think that not falling in love with a particular strategy or a recipe where this is what I do, and being kind of malleable depending on what the market's telling you. And again, that does not happen overnight. And hopefully being able to take your cues. Again, this is me going back to the art of it, taking your cues from what's going on in the market then and there and what sort of risk you are comfortable assuming given that overall picture is more to the point. Like there is not a recipe for this is the right way to trade options, for this is the right way to roll. There simply isn't. There is a constantly evolving market that will present you with opportunities and risks, and the better you become at being able to read that, I think the more empowering kind of options are generally.
Outstanding. One last thing I want to ask you, and I don't know if this is black and white or not, but let's say a position goes against you, and this speaks to some of the flexibility you were just speaking of. You got a position going against you. You think it's better to close it and move on to something else, or to roll?
That's a great question. I think there's a time and a place for both. I would go back to if my plan from the outset was, if this happens, something adverse, I close, then that's what you do. What I would say is, in that scenario, you know your risk, okay? Your risk is taken off the table when you close it, and there's something also to be said for the kind of mental capital that's expended if you get caught in a roll game, all right? You can get back in the market a day later, an hour later, 2 weeks later, if it makes more sense. I am not saying that rolling can't make a whole lot of sense, even in scenarios where your potentially kind of hand is forced as far as that goes. But at least considering maybe this is a scenario where I just close this off and I move on is something that you should at least be in the habit of asking yourself anytime you're looking at a roll. So I do not have the answers. Nobody does. But I think the more flexible you allow yourself to be, flexible with genuine discipline, the better off you're going to be.
Kevin, you're giving me goosebumps, man. If I may say, you are. If I may say so myself, just fabulous insights. Listeners, this is Kevin Davitt, instructor at the CBOEs Options Institute. Kevin obviously is educating on behalf of the CBOE. He's also out on the road for the OIC, Options Industry Council, at some of our live events. Just great stuff, Kevin. I don't know if you have any closing thoughts, but because you've said so much, but if you have one, or please feel free.
My closing thoughts in this situation is, I apologize for coughing. I got caught there, and it's difficult, like trying to get out what you want to say, and I know that can be annoying. So I apologize for that, and thank you for the opportunity to come on this afternoon.
All good, Kevin. Thanks so much for joining us today. That's it for today's Strategy Spotlight with Kevin Davitt of the Options Institute.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Stan Freifeld, Director of Corporate Services and Option Mentoring at McMillan Analysis Corp. Stan, it's great to have you on. Thanks for joining us today.
Thank you so much, Joe. I'm very happy to be here.
Well, we got a good group of listeners that are anxious to get to learn something about you and McMillan, so let's get right at it. Tell us about yourself, how you landed up in the options education business.
Well, sure, I'd be happy to. I started out as an actuary, and if you know what that is, a lot of people look at me like I have three eyes when I tell them I was an actuary, but an actuary is somebody basically who's good at math, and I was working at an insurance company first, and then eventually I had my own pension consulting firm, and I was working long hours, and it was difficult. I had sometimes I had to go in on weekends, and I was working late during the week. I had a young child at the time, and so I wanted to get into something else. I looked at floor trading, and to me that seemed like the way to go, because option traders need to be good at math, and I had that quality. And also, the hours seemed to be a lot better for me. You couldn't work overtime. You couldn't go in early. You couldn't stay late. The market was closed, and there weren't any weekends. Plus, you got every holiday off. So it seemed like a good way to go for my situation at the time.
Is that why maybe I landed up doing that for 23 years, you think, Stan?
Right. I loved being a floor trader. I was a floor trader for 9 years, actually. I was there from early in the 90s through 9/11. I left actually on 9/11. I was planning to leave around that time, but not that day. But that was it. After 9/11, I didn't go back.
Yeah, well, you got a wonderful background, and certainly that period of time, you get into the tech bubble of the late 90s, and then all that went on, as you say, we get into the 9/11 period. Trading options on the floor was really, for those of us who had an opportunity to do it, was really, pretty special. But let's talk a little bit more about, how long you've been with the McMillan team and how that came about.
Well, it's interesting. Having been a floor trader, I was involved in a lot. There was a lot going on the floor. There's a lot, as you know, a lot of noise, a lot of activity, a lot of people. After 9/11, when I left the floor, I was trading from an office. It was very quiet. It was me and a computer, and that wasn't really my personality. So I decided I wanted to get involved more with people. I still trade I've always traded. I love trading, but I wanted to be more involved with people. So I called Larry McMillan, and I knew of Larry. I didn't know him personally, but his reputation was stellar for integrity and a brilliant guru, having written several option books. I called him. I said, Larry, I'd like to set up a mentoring program. What do you think? And he said, well, why don't we get together for lunch? We'll talk about it. And here we are about 10 and a half, almost 11 years. I think in December it'll be 11 years later. That's what we've been doing.
Oh, that's fantastic, Stan. And I did not know that story where you reached out to Larry and made your own luck, just fantastic. That's awesome. You mentioned, Larry's books. Tell our listeners about, what you guys have put together there from a book perspective.
Well, yeah, Larry has really put together an amazing company. There are several different lines of business. He has three newsletters. They're for different purposes, and they relate to different types of trading. We provide trade recommendations, and then there's the educational aspect of it. Larry's written two really excellent option books, and he has chapters in several other option books. But his main book, Options as a Strategic Investment, is considered as the Bible of options trading by a lot of people. It's used in graduate courses in several colleges, and it's a book that gives people a very good start of getting into the options business, and it's very comprehensive. It's not only for novices, it's for novices, intermediates, and also for advanced traders. We also have a set of CDs, we have DVDs, a lot of educational products.
That's really a great overview. Now, how about if we hone in a little bit on the options aspect, because that's certainly what McMillan focuses on, the whole idea of options. So how do you guys approach investing and education as it relates to options?
Well, as I'm sure, as I know you are well aware, options provide a tremendous amount of flexibility for investors and for traders. Particularly, you could provide insurance to a portfolio. They could provide income. They could provide speculation for those who want to be a little bit more aggressive. You could have you could trade options conservatively or more aggressively. They fit into long and short investments and all different types of market conditions: bullish, bearish, stagnant, trending, choppy, you name it. And also, just generically, there are several different ways that we could trade options. We could trade in terms of volatility, or we could trade directionally, or we could trade a combination of both. So there's so much flexibility, and that's what we try to do in terms of the education that we provide to people who want to learn how to trade options. Options can fit into, I would say, just about everybody's portfolio in one way or another.
So your approach sounds like it's quite open-minded rather than forcing an approach on a potential investor. It sounds like there's an awful lot of give and take there.
Well, that's exactly right. We try and show the flexibility and teach different strategies to those who want to learn how to trade. And then it depends on the market conditions to choose the proper strategy.
Well, given that you came to Lowry to put together this mentoring program, not sure how relevant this question is, but I think I'll ask it anyway. Does your investment approach, with the use of options align completely with, Lowry's?
Well, we're both independent traders, so there are some differences in how we think about things. I'll give you a couple of examples. One is technical analysis. I'm not a big proponent of technical analysis. In fact, I have a quote that goes around in the office, and that is, technical analysis is great for predicting the past, but I'm more skeptical about its ability to predict the future. And that's kind of how I feel about technical analysis, and I know a lot of traders disagree with that, and some of the recommendations, fair enough, and some of the recommendations that we put out are based on technical analysis. Now, that's not the way that I personally trade. I tend to trade a lot with earnings events, and there for a number of reasons, Joe. I'll tell you. I like earnings because, first of all, we have a history. Every public company has to report earnings quarterly. So any company that's been around for a while, we have a history of what's going to happen when earnings are reported. And so that certainly gives us a little bit of a leg up. But what I really like so much about earnings is the way there's something about them that we know that happens 95% of the time. And I'll tell you what that is. It's that when earnings come out, a company announces their earnings, volatility of the options will decrease. We call that a volatility crush. And there are very few things that we know for certain, or with a 95, let's say, percent probability, and that's one of them. So I tend to use that in my own personal trading. And even with that, there are two different types of strategies. One where we hold a position through earnings to get that volatility crush, but then there's an additional strategy where we purchase options prior to earnings, and then we take the position off just before the earnings are released, when hopefully volatility is very high. So we're in that situation, we're banking on a volatility increase. When we hold through earnings, we're banking on the volatility coming in, decreasing. It's not a guarantee that we're going to make money, but it gives us a leg up on the market in some situations.
Well, that's interesting. And maybe without getting too deep in the weeds. So, we initiate one position where we're looking to get out in advance of the crush, right? I mean, basically, okay. And so Can you give us a ballpark time frame when you may initiate and when you may sell in advance of earnings?
Well, there are several different strategies that use that basic concept. One is where we're putting on a position maybe 2 to 3 weeks prior to the earnings event.
Okay.
When the volatility hasn't started to increase yet. And then there's another type of situation. In fact, I have a particular trade We refer to it as the best strategy. And if you know me, Joe, you know I'd never say something is really the best, but it's an acronym, BEST, Before Earnings Straddle Trade. And that's the kind of trade that we actually put on the day that earnings are supposed to be coming out. So if earnings were coming out today, I'd put it on in the morning, and I would take it off later in that same day. But of course, I'm just giving you a very general idea about it. I don't want the listeners to go and start buying options every day that earnings are coming out on a particular trade. The devil is in the details, as they say.
Indeed it is, and one of the great things about, trading earnings, as you said earlier, you've got a track record going back over time.
Exactly.
And so you've obviously got the earnings, you got the forward looks, but from my perspective, you've got volatility charts. And how much do the volatility charts come into play with, whether you initiate a volatility position or not, Stan?
Well, when you say how much do they come into play, I'd have to say pretty close to 100%. I mean, that's
Perfect.
What we're really doing. We're trading volatility. This is not a directional type of trade. We're not saying if the earnings are good, the stock is going to go up, or if the earnings are bad, the stock is going to go down. We don't try and make that type of prediction. What we say is that volatility is normally trading around 30. It's now gone up to 50, and we expect after the earnings come out, it's going to go back to 30 or approximately. That's just the general idea of how that type of trade would work. That's the trade where we're holding through earnings.
Well, I love the fact that, and for those of us who have been in the space for quite some time, especially to our new listeners, Stan, is focusing on volatility, and when you talk about using options or trading options, you really have to spend some time without you really need to spend some time beginning to understand what implied volatility is in an option, because it really does drive the value of your option prices. So love that conversation, Stan. Rolling over a little bit in terms of what you enjoy about the business. What are the things you like most about being in the options education business?
Well, I've got to tell you, I'm considered a natural teacher. I just like explaining things to people. And even when I was on the floor standing next to guys who were my competition, they'd ask questions, and I couldn't help myself. I would always answer honestly and truthfully, and explain how things work to the extent that I knew how they worked. Also, I like being in this business because it gives me a chance to meet so many people from around the world that I probably wouldn't have a chance to meet otherwise. And I've met all kinds of very interesting customers and people that I deal with. I've had a professional tennis player, a world-ranked tennis player as a student, someone who worked for NASA, someone who is one of the two people who ran a nuclear power plant in Toronto. I mean, just people that I would have no access to, very interesting people. That's what really keeps me going. So between that and doing my own trading, I feel I really, I'm very lucky to be in the position that I'm at.
Well, that's great. And, assisting fellow traders, that just speaks to the type of person you are, because that's pretty much unheard of in our business. And the other, did you ever get into a barter deal where, how's your tennis game?
I'd have to consider myself a novice tennis player. I love to play, but I'm still a novice. Okay.
Now, how about the flip side? You get the opportunity to speak to all these interesting people. A couple things, are there certain things you don't like? And then taking it maybe even a step further, are there, mistakes that you see, these investors who come to you make over and over again?
Well, yeah, I'll respond to both of those, Joe, and that is the part that, well, I don't even want to say that I don't like it, but part of it gets a bit repetitive. I train people at all different levels, from novice to some very advanced traders, and I've had some academics, some finance professors. I've had 3 of those. But sometimes the material, having gone over it so often, it's very repetitive to me. So that, sometimes I'm a little, I get a little tired of that. But still, every experience is a new experience. And I also feel I'm giving back a little to this industry. This industry has been very good to me. It's afforded me things that, perhaps I might not have been able to get as an actuary. And so it's worked real well. As far as mistakes that I see people making, you have to understand that this is a very competitive business that we're in. And it's not like a baker who takes some ingredients, throws them into a pot, and mixes it up, and then comes out with a cake that's worth more than the sum of the ingredients. Money only changes hands when we're trading options. So we're not creating any new money. So it's very important that people who are trading are properly educated, that they're motivated, and they take it very seriously. What I see sometimes that I really don't like is when people aren't using all the tools that they have at their disposal. For example, the Greeks. If you're not using the Greeks when you're trading, it puts you at a severe disadvantage. It's almost like driving a car without looking at the speedometer or the gas gauge. Think of the Greeks as your gauges. And so it's very important that you use the Greeks, you use a trading model, a pricing model, to be competitive with everybody else that's out there.
Well, Stan, really appreciate the opportunity to talk to you and, offer our listeners your wisdom on the industry. It's been a lot of fun, and, I just want to thank you for making the time to join us today.
It's a pleasure, Joe, and thanks for having me. And we should all know the power of options.
Amen to that, Stan. And that's today's Profiles and Perspectives with Stan Freifeld of McMillan's Analysis Corp. Thanks again, Stan.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's Tools, Resources, and Good Reads, we'll start with 2 items from our website, optionseducation.org. The tool is the Strategy Screener, which allows you to filter strategies that will profit from a sharp move in the underlying. That's the Strategy Screener at optionseducation.org. Our resource, which is also found on our website, is the Position Simulator. It allows you to conduct the all-important what-if analysis in different scenarios. What if the underlying moves big up or down? What if volatility moves? What happens when we get closer to expiration? All the what-ifs you can think of, you can run through the Position Simulator at optionseducation.org. And finally, today's good read is The Big Short by Michael Lewis. It's a book about the investor experiences of the 2008 financial crisis. As an aside, and I'm one who really does not like movies on Wall Street, I did see The Big Short. I thought it was a phenomenal movie because it spoke to the psyche of the trader. And as a longtime trader, it just really hit a sweet spot for me. So that's The Big Short by Michael Lewis. Thanks for listening. That's today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're taking a little different approach. My colleague Bill Ryan from Investor Services suggested the following topic. Remind our listeners the October 87 crash happened the day after an option's expiration. Now, please stop and think about that. What if you had an option position back then, or think about if you have one now? What if your underlying moved down 23% in one day? One day. How would you fare? Would you make or lose money? One day, down 23%. Do you know if your option position would be profitable or not? Now take it a step further, as Bill suggests. Let's say Friday was expiration and your option positions expired. None left. How would your portfolio change after expiration? Do you have more or less exposure to the market? Is everything from a risk perspective still the same? Lots of very important questions. Do you know the impact of your option position when the underlying moves big, up or down? What does your position look like after expiration? What's your plan if you get such a move? Ideally, you know the answers to these questions, which speak to the key component in investing, risk management. I hope you know the answers. If not, I hope you'll think about them going forward. Thanks for the idea, Bill. That's today's Looking Back.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.